Imagine you have $100,000 to invest right now. The economic signals are mixed, and one key metric on everyone's radar is the yield curve, specifically the spread between the 10-year and 2-year US Treasury yields. As of early September 2025, this spread is still around 0.5 after being negative for an unusually long period. Why is this important? Historically, an inverted yield curve when short-term yields exceed long-term yields has been a reliable harbinger of trouble, preceding every US recession since 1955 by roughly 6 to 24 months. For example, the 10-2 spread flipped negative in 2006, not long before the 2008 financial crisis, and again in 2019 before the brief 2020 recession. Most dramatically, the curve went negative in July 2022 and stayed inverted until late August 2024, one of the longest such inversions on record. Now that the curve has inverted and turned positive again, many analysts caution this steepening may be a lagging warning sign. Each time the yield curve reverted to normal after a deep inversion, as in 2001 and 2008, a recession followed soon after. In fact, when the curve steepens after a tightening cycle, it often signals that the most severe economic pain is still ahead. In short, we're not out of the woods yet. The yield curve's return to positive territory could be signaling systemic fragility. Not all clear here. The chart above shows the 10-year, 2-year Treasury spread dipping below zero in 2006, 2007, and 2019, and the deep inversion from 2022, 2024 before rising back above zero in 2025. Adding to the uneasy backdrop, gold prices have been surging in 2025, hitting all-time highs. Gold is the classic fear gauge for investors, and its rise signals flight to safety amid uncertainty. In fact, gold has soared more than 30% over the past year. For context, gold was around $1,900, $2,000 just a couple of years ago. Now it's well over $3,600 and climbing above. This rush into gold suggests that many are hedging against volatile stocks, high inflation, and potential crisis. A sentiment echoed by central banks and traders piling into the metal as a safe haven. In other words, the market is on edge, and even smart money is bracing for turbulences. So how should one invest $100,000 against this backdrop of high uncertainty? On one hand, interest rates are at their highest in years, making cash and bonds more attractive than they've been in over a decade. On the other hand, inflation and the possibility that Fed continues cutting rates if the economy weakens clouds the outlook for those same bonds. Stocks have been on wide roller coaster. A traditional 60-40 stock bond portfolio at its worst year since 1937 in 2022, only to rebound sharply in 2023. Real estate prices are sky high and arguably overvalued, but property can provide income and inflation protection if bought right. And then there's a newer, less conventional approach, a beta-neutral hedging strategy, like the one we run at Kapital, designed to generate returns independent of market directions. Beta-neutral means the portfolio's returns aren't correlated with overall market swings. In statistical terms, it targets a beta of 0. So it doesn't matter whether the S&P 500 or bond market rise or fall. This strategy aims to extract profit through market inefficiencies and hedging rather than reliance on asset appreciation or Fed policy. We'll delve into that as one of the scenarios. In this deep dive video, we'll break down 4 distinct investment scenarios for deploying $100,000 in these uncertain times. Each scenario will be personified by an individual investor with different goals and risk tolerances. Sarah puts $100,000 into real estate, a short-term rental property like Airbnb. We'll examine the cash flow and equity risk, especially given today's frothy housing market. David puts $100,000 into treasuries, 100% in short-term US Treasury bills. We look at the safety and yield of this parking in cash approach and its long-term pitfalls. Layla builds a 60-40 portfolio, $60,000 in stocks, specifically QQQ Nasdaq 100 ETF, for example, and $40,000 in bonds. We'll discuss the pros and cons of this classic balance strategy and why it struggled recently. 4th scenario will be myself running Kapital engine, allocating $20,000 to our hedge prop trading strategy and keeping $80,000 in cash. We'll show how our beta-neutral prop firm strategy works as a market-neutral return engine, leveraging prop firm trading capital, and why it's not reliant on Fed rate cuts or any bull market to generate profits. Let's dive into each scenario and see how they stack up and what their trade-offs are in an environment where macro risk is high and nothing is certain. Sarah decides to put her entire $100,000 into buying a rental property, specifically a short-term vacation rental like an Airbnb, beach condo, or a cabin. She's attracted by the idea of tangible assets and passive income. Let's say with $100,000, she either makes a down payment, leveraging a mortgage, or buys a small property outright in a cheaper market. What kind of returns might she expect? In a rosy scenario, a well-chosen short-term rental can gross around 10% of the property's value in annual rental income. For $100,000 of property, that's roughly $10,000 per year in revenue before expenses. This aligns with typical cap rates. A good short-term rental might yield 5 to 10% net return on investment, depending on location and management efficiency. Sarah imagines earning $800, $1,000 a month in rent, which sounds like a solid 10% return on her $100,000, far better than a bank account. Plus, she's building equity in the home. However, real estate comes with significant risks and headaches, specifically in 2025's climate. Home prices are widely viewed as overvalued right now. In fact, Fitch Ratings recently estimated US home prices were about 11% higher than fundamental value as of late 2024, with 85% of metro areas overvalued to some extent. Many experts are concerned that after years of rapid price appreciation and now high mortgage rates damping affordability, housing is due for a correction. While a crash isn't universally expected, low inventory is propping up prices in many regions. Even a modest 10 to 20% price decline in overpriced markets is a real possibility if the economy soars or rates stay high. Sarah's $100,000 property could lose $20,000 in value with a 20% downturn, wiping out 2 years' worth of rent gains in one swoop. This equity risk is the flip side of real estate. Leverage magnifies it further. If Sarah took a mortgage, a price drop could erase her down payment equity quickly. Beyond market risk, being a landlord carries cost and effort. Short-term rentals have high turnover and management overhead. Marketing the listing, cleaning and maintenance between guests, property management fees if she's not doing it herself, insurance, utilities, and property taxes. That optimistic 10% gross yield can shrink to a much lower net yield after all expenses. For instance, a 10% gross cap rate might net more like 5 to 7% after costs, which could end up similar to a less labor-intensive investment. And if tourism slows or local regulations change, many cities are cracking down on Airbnb rentals. Her rental income could drop, turning her into an accidental long-term landlord or leaving her with vacancies. Looking at current market conditions, it's worth noting that mortgage rates in 2025 are high, 6 to 7% for 30-year loans, which means if Sarah financed the property, interest costs eat heavily into that 10% yield, possibly completely. High financing costs also cool buyer demand, which is partly why prices could soften despite low supply. Some regions have already seen slight declines, like parts of Florida that are a few percent off their peak, though nationally prices are roughly flat to slightly rising year over year. The bottom line is, real estate is a bet on both income and asset value. Sarah might enjoy steady rental income and even appreciation if the economy has a soft landing, but she's exposed if the housing market slumps, say a recession forces price down 15-20%, her $100,000 could shrink to $80,000 on paper, erasing gains. And unlike stocks or bonds, real estate is illiquid. She can't sell a bedroom to raise cash, and selling the whole property is slow and costly. Let's look at Sarah's real estate investment pros and cons. In the pros, we have tangible assets with utility value, a place to stay, potential for 5 to 10% annual rental yields, tax advantages, and a hedge if inflation stays high. Rents and property values often rise with inflation. We must also mention that housing is a real asset that historically holds value in the long run, and a short-term rental lets her use the property herself occasionally, a lifestyle perk. About the cons, it's highly illiquid. Selling could take months and involve 6% agent fees. The market risk of a price downturn is also a con. Many homes are 10% overvalued now. We also have significant active management requirements or expenses for property managers. Also consider that a bad year with few bookings or a major repair could bring her yield way down. Plus, $100,000 concentrated in one property means no diversification. If that local market suffers, I don't know, maybe a hurricane, new regulations, economic decline, her entire investment is impacted. Sarah's play is essentially a long-term bet on real estate. She forgoes liquidity and takes on property-specific risk in exchange for income and potential appreciation. It could pay off nice if the economy goes along and inflation makes her fixed mortgage relatively cheaper while rents rise. But if we hit a recession and housing falters, Sarah could be stuck with a non-performing asset or even a loan underwater. In uncertain markets, real estate is appealing, but not the surefire bet it used to be. Sarah needs to be prepared for the scenario where her optimistic 10% return turns into a negative year or two. David chooses to park his $100,000 entirely in US Treasury bills, specifically rolling 6-month T-bills. This is basically the super conservative cash-like strategy, lending money to the US government for very short periods. The appeal: Treasury bills are considered default risk-free, backed by the US government, and short maturities mean it is not locked in for long. In today's high-rate environment, 6-month T-bills yield around 3.8%. They were even above 5% earlier in the year when the Fed's policy rate was higher. Let's assume 4% to simplify computations. That would generate about $4,000 in annual interest on $100,000. It's not exciting growth, but it's steady, ultra-liquid income. David can literally log in to Treasury Direct or his brokerage account and see the interest accrue, with virtually no volatility in his principal. Every 6 months, he can reinvest into new T-bills at the prevailing rate or cash out if needed. It's the ultimate sleep-at-night path, or it seems to. About the advantages, short-term treasuries are often dubbed risk-free rate investments for a good reason. Barring a US government default, which is extremely unlikely and would upend global finance, David will get his $100,000 back at maturity guaranteed, plus interest. There is no credit risk and minimal price fluctuation. If he holds each bill to its 6 months maturity, he doesn't care about interim price moves. The investment is highly liquid. He could sell the T-bills in the secondary market anytime, or just wait a few months for them to mature. In an uncertain market, holding short treasuries is a form of patience. He's staying safe, keeping his powder dry, and earning a bit of yield while waiting for clarity. Importantly, treasury interest is exempt from state income taxes, which gives a small boost if David lives in a high-tax state. But is it truly risk-free? Over a short horizon, months, yes, US T-bills are as safe as it gets. Over a longer horizon, however, David faces other risks. One is reinvestment risk. Since he's only locked in rates for 6 months at a time, there is no guarantee what yield you get next. If the Fed continues to cut rates in late 2025, as many expect if the economy weakens, the yield on a 6-month bills could fall sharply. For example, if in a year the 6-month T-bill yield drops to, say, 2%, David's income would be cut in half on the next roll. As finance professor Aswath Damodaran notes, a 6-month T-bill, while default-free, will not be risk-free for a 5-year investment horizon, because you don't know what the T-bill rate will be in 6 months. In other words, there's uncertainty about future interest earnings. That's reinvestment risk. Another issue is inflation risk. If inflation runs hot, say 5% annually, while David's T-bill yields 4%, he's actually losing purchasing power in real terms. And if, conversely, we enter a deflationary or recessionary period and interest rates plunge, his future yields will drop, potentially leaving him with very little growth on his capital. There's also opportunity risk. If stocks or other assets rally strongly, David's 4% yield might look paltry by comparison. He might miss out on gains by staying on the sidelines. Finally, one might consider interest rate sensitivity. Though for 6-month bills this is minimal, bond prices fall when rates rise, but because David's bill matures so soon, their price doesn't move much with rate changes. Longer-term bonds have more duration risk, like a 10-year bond could lose significant value if rates spike. David has wisely avoided that by sticking to short-term maturities. He's effectively dodged interest rate risk in the price sense. A 6-month bill is virtually risk-free in terms of interest rate volatility. But if he ever ventured into longer treasuries for higher yield, that risk would increase, as 2022 taught many bondholders who saw safe 10-year bonds drop 15% in price when yields jumped. About David's mindset, he's comfortable foregoing big upside for capital preservation. This approach is very conservative and suitable for someone who prioritizes liquidity and certainty over growth. It's a common strategy in uncertain times. In fact, short-term treasuries have seen huge inflows recently as investors seek refuge and earn some yield while they wait. What about the pros and cons of David's alt treasury strategy? About the pros. Maximum safety of principal, backed by US Treasury. It's very liquid. Cash is available on short notice. Modest but steady interest, 3 to 4% currently, that far exceeds bank savings rates of recent years. No exposure to stock market volatility. The dry powder approach, you can always redeploy into riskier assets later if conditions improve without having lost much and earning a bit in the meantime. Also, no active management required. Set it and forget it with auto rollovers. About the cons, we have low return ceiling. 4% yield is minimal growth, arguably just keeping pace with inflation at best. Reinvestment risk if rates fall, his income drops. After tax, real returns could be near zero or negative in high inflation. Virtually no upside beyond the fixed interest, unlike stocks or real estate. Treasuries won't surprise you on the upside. From a financial standpoint, if the Fed rapidly cuts rates, David could experience rate envy, watching later T-bill yields fall and regretting not locking in longer-term bonds or other investment when yields were high. Overall, David's strategy is the epitome of capital preservation. It will hold its value in most scenarios, except if we have very high inflation in very short term. However, it won't make him rich. In fact, after a few years, $100,000 might only be $110,000 before inflation adjustment in this approach. It's a sensible choice if you expect a storm soon and want to preserve cash to seize opportunities later. But if the storm never comes and markets roar ahead, David will lag far behind. It's the classic risk-reward trade-off. He's traded away virtually all risk, and with it, most reward. Layla splits her $100,000 into a 60-40 portfolio, $60,000 in stocks and $40,000 in bonds. This is a classic investment strategy that has been a staple of portfolio management for decades, often recommended for an investor with moderate risk tolerance, like approaching retirement or just not wanting 100% stock volatility. Layla chooses to put the equity portion into a broad tech heavy index fund, say QQQ, Nasdaq 100 ETF, for growth, and the bond portion into a mix of high quality bonds. Could be a total bond market fund or treasury bonds for stability and income. The idea is that stocks provide upside and higher long-term returns, while bonds provide income and act as a ballast when stocks have rough periods. Historically, a 60-40, especially one using broad S&P 500 and aggregate bond indices, has delivered about 7 to 8% annual returns over many decades, with gentle swings than an all-stock portfolio. However, Recent history gave 60/40 investors a gut check. In 2022, the traditional 60/40 portfolio suffered the 17.5% loss, its worst annual performance since 1937. What happened? Unusual combo of a bear market in stocks and a bear market in bonds occurred simultaneously. The Nasdaq 100, which QQQ tracks, plunged by about 33% in 2022, as highly flying tech stocks collapsed from pandemic highs, and even the broad S&P fell 19 to 20%. At that same time, surging inflation and Fed rate hikes caused bond prices to fall sharply. The US aggregate bond index was down about 13%, and 10-year Treasury bonds dropped in price as yields spiked from 1.5% to 4%. This meant Layla's stocks and bonds lost money together, offering little protection. In normal recessions or market crashes, bonds often rise, or at least hold value, as a flight to safety and as the Fed cuts rates. Like in 2008 or 2009, treasuries rallied even though stocks were down big, cushioning a 60/40's loss to some extent. But 2022 was a perfect storm. Both sides of the 60/40 were hit by the same driver, inflation and rate shocks. The result was a rare double drawdown, and the venerable 60/40 had one of its worst years in almost a century. Now in 2025, some of those pressures have reversed. 2023 saw a strong rebound. Stocks ripped higher and bonds stabilized as yields plateaued. But Layla must consider volatility. QQQ is quite volatile. It can deliver huge gains. It sold 48% in 2020, for example, but also steep losses. We noted 33% in 2022, and it fell 37% in the early 2000 tech crash. By allocating 60% to such growth stocks, Layla is accepting that portion could swing widely year to year. The 40% in bonds should, in theory, mitigate that. When stocks fall, often bonds rally, or at least don't fall as much, smoothing the ride. And indeed, over long periods, the 60/40 is less volatile than 100% stocks, but as we saw, it's not immune to simultaneous declines. About the exposure to macro cycles, Layla's portfolio is still significantly tied to the fate of the economy and interest rates. If we get a recession, stocks, especially cyclical tech stocks in QQQ, could drop substantially, perhaps 20-30% or even more. Bonds might help if the Fed slashes rates, bond prices would rise, but if the recession is accompanied by sticky inflation, bonds could also struggle. Conversely, if the economy unexpectedly booms, stocks would do great, but then the Fed might raise rates more, hurting bonds a bit. There's a push-pull. In a sense, a 60/40 is diversified, but not magic. It spreads bets across asset classes, but extreme macro events can still impact both. It does reduce risk compared to old stock. For example, in March 2020's COVID crash, a 60/40 fell roughly half as much as the S&P's, 34% plunge, and rebounded quickly with the help of both Fed easing, boosting bonds, and stimulus, boosting stocks. Most of the time, the 60/40's bond sleeve provides income and modest growth with lower volatility, which pairs nicely with stocks' higher but rockier returns. In the current environment, Layla's bonds, if she holds a mix of treasuries and investment-grade corporates, might be yielding 4 or 5% now, which is actually the highest in years, a silver lining of rate hikes. That means if stocks go sideways, her 40% allocation could generate perhaps $1,500, $2,000 a year in interest, cushioning total returns. Also, if inflation comes down and the Fed continues to cut rates, those bonds could appreciate in price, giving some capital gains. Meanwhile, the stock portion, Nasdaq 100, gives growth potential. It's heavily weighted in tech giants that could continue to thrive or at least have secular growth because of AI, cloud, etc. But it's also quite concentrated. QQQ is dominated by a handful of mega-cap tech stocks. That introduces some concentration risk, though many would argue those top companies are robust. About volatility and drawdown, Layla should be ready for a moderate roller coaster. A 60/40 can still drop 10 to 20% in a bad year or bear market. Historically, maybe 1 year in 4 or 5 is negative for a 60/40. The worst case historical scenarios, like 2008 or 2022, saw high teens to low 20s% declines. That's a $17,000 to $20,000 paper loss on $100,000 in a really rough year. If she can stomach that and stay invested, the idea is that the portfolio will recover as it has in the past. It's a long-term play. You ride out storms with understanding that over, say, 10 plus years, the 60/40 should deliver solid risk-adjusted returns, not as high as all stocks, but with smoother progress. What about the pros and cons of latest balanced 60/40? In the pros, diversification across asset classes. Bonds tend to offset some stock risk. Historically reliable, with long-term return, 7 to 8% a year and fewer gut-wrenching swings than pure equities. It's simpler to maintain an active trading. Just need to rebalance annually to keep the 60/40 mix. It provides income from bonds and growth from stocks. After 2022's reset, bond yields are higher, so the 40% bond side now contributes more return than it did when yields were near zero. A 60/40 is often called a balanced approach for a reason. It's grounded in the idea of not putting all eggs in one basket. About the cons, it's not foolproof in prices, can suffer losses on both sides in rare scenarios, still has significant volatility. A 17% loss in 2022 proved that. The 60% in stocks, especially if concentrated in Nasdaq, means it can be quite tech sector heavy. That's not a broadly diversified equity exposure. Layla might consider a broader index or adding international stocks to diversify further. Also, the traditional 60-40 assumes historical correlations, meaning if the stocks goes down, the bonds goes up, which may not always hold. In a regime shift, say persistent inflation and rising rates, the old correlation could flip as it did recently. Finally, while simpler than picking individual stocks, it still requires discipline. One must rebalance, selling some winners to buy losers each year, which can be emotionally tough, but is key to maintaining the risk profile. In summary, Layla's approach is the time-tested compromise. It doesn't chase the highest highs, but it avoids the lowest lows, mostly. It's the kind of portfolio that many financial advisors would suggest for an all-weather strategy. In uncertain markets, it provides a middle path. You're betting on human enterprise with stocks, but also carrying a safety raft of bonds if things go south. Just remember that in a rare storm like 2022, even the safety raft can get tossed around. After that storm, though, many are sticking with 60-40 or even 60-40 2.0, some tweaks like adding alternative assets, rather than abandoning it because over decades it has delivered a good balance. Layla, presumably with a moderate risk appetite, finds this mix comfortable. She can handle some drops but doesn't want to go all in on any one bet. Here's a completely different way to use $100,000. Deploy only $20,000 into an actively managed trading strategies, our XO hedge engine, for example, and keep the other $80,000 in cash reserves. The goal of this strategy is to generate consistent, uncorrelated returns using the $20,000 as margin to control a much larger trading portfolio through proprietary trading firm accounts, or most known as prop firms, while the bulk of your money, the $80,000, stays safe on the side. In our case, we partner with firms like FTMO, which provide funded trading accounts. For example, with $20,000, we might secure and manage around $400,000 portfolio in prop firm accounts, since prop firms allow high leverage on demo accounts that translate into real profit splits. In fact, as of now, XO Capital is managing about $5 million in prop firm portfolio across multiple FTMO accounts, effectively leveraging our strategies across a multi-million-dollar trading portfolio. All while our clients' own capital, the security deposit, remains mostly unused except for covering fees or potential losses. The $80,000 cash reserve serves multiple purposes. It's a safety cushion. It provides flexibility. The client can deploy it elsewhere or add trading if desired. And psychologically, it lets you know that most of your money is not at direct risk in the market or any given day. Only a small fraction is at work in the trading system. But due to prop firm leverage, that $20,000 can control, say, a $400,000 trading account. Just as an illustrative example. This is how we aim to generate meaningful returns on the whole $100,000 without exposing the full $100,000 to market volatility. The strategy is designed to be beta delta neutral, meaning we structure trades such that directional market moves are hedged. For instance, we might go long on one index and short on a correlated index. It's like using options futures in pairs that offset each other's market risk. The profit comes from exploiting relative value, mean reversion, or other market inefficiencies rather than betting on the up or down. The result, when it works as designed, is a stream of return that has no correlation to stock market ups and downs. In theory, whether the S&P 500 soars or crashes, our hedged positions net out the market beta and still extract some positive gains, kind of like market-neutral hedge funds or certain arbitrage strategies. To make it concrete, imagine we trade major currency pairs on two linked accounts. One account might take a long position on, let's say, Euro USD, while simultaneously another account takes a short position. We just need the market to go up or down, and thanks to a special hedging ratio and the prop firm leverage, we can make profit at the end using this process. It's complex under the hood, but the upshot is a low-risk hedge profit engine. We call it hedge-protected trading. Importantly, this is all done on FTMO's simulated accounts with their capital, so our client is not losing their own money if trades goes wrong. At worst, they might lose access to a funded account that we just need to rinse and repeat with the profit made on the other side. Essentially, the $20,000 at risk is mostly the fee to engage in this prop trading program and to cover any potential hedging collateral retries. So it's not being directly traded in the market. Meanwhile, if trading is successful, the profits are very real. FTMO pays out real cash rewards on the demo accounts gain. Those profits are split. FTMO typically keeps 20% and 80% goes to us and our client. We then split that with the client per our service agreement. We only take a cut when the client makes a profit. This alignment of incentives is crucial. Unlike many financial services that you'll find online, we only earn when our clients earn. If a month yields no profit, our client pays us nothing for that period. This model is set on purpose so that we have skin in the game and are motivated purely by performance, not by collecting yearly fees regardless of results. To give a sense of scale, suppose our trading across those prop accounts yields a modest 5% monthly gain on the prop capital. On a $400K funded account, 5% is $20,000. FTMO would pay you 80% of that, which is $16,000. That $16,000 is real money that our client and XO split, say 50-50 for example's sake, so the client nets $8,000. That would be a phenomenal return relative to the 20,000 they actually put at risk, effectively a 40% gain on their cash that month. Now, that's a high target and not every month hits that, of course, and they are losing periods too, but it illustrates the power of prop firm leverage plus skillful hedging. We typically aim for more conservative monthly returns to manage risk, but over a year, the goal is to significantly outperform traditional investments without relation to them. It's not magic or free money. It requires careful risk management, discipline to obey prop firm rules like max daily loss limits, and a lot of trading expertise. But when executed well, it produces a smooth equity curve compared to, say, the jagged ride of stocks. In August and September, for instance, our various FGMO accounts pulled in several $1,000s each in profit rewards. Let me put out those payouts on the screen right now. Again, these profits didn't depend on whether the stock market was up or down those months. They came from our strategic trading moves in a hedge manner. Now, you might ask yourself, why keep the $80,000 in cash? Aside from being a caution, we recommend not deploying it elsewhere so that the client remains very liquid and secure. We don't ask for that 80,000 to be given to us or locked up. It stays under the client's full control. Now, about the pros and cons of XO hedge prop strategy. About the pros, the strategy gives you market neutral returns. It's truly uncorrelated with stocks or bonds, which is priceless in uncertain markets. You're only putting a small fraction of capital at risk. Potential for high returns thanks to leverage on prop firm capital, effectively earnings on money that isn't yours, splitting the gains. Our incentives are aligned. We profit only when you profit, unlike many services or e-learning courses or even prop firms themselves, who actually profit from challenge fees of failed traders. Also, no direct exposure to Fed policy or economic cycles. We're not betting on hope the Fed cuts rates or hope tech stocks goes up. Our strategy is dynamic and can profit in bull or bear conditions. It's a hands-off for the client. We manage the complex trading. The client just monitors results and enjoys a relatively stable return stream. About the cons. It's a sophisticated, actively managed strategy, not easy to do it yourself. There's reliance on the skill and integrity of the manager, XO Kapital in that case. It's also somewhat opaque compared to simply buying an index fund. Not everyone is comfortable with not fully understanding the trading system. Prop firm programs have their own risks. Their firm could change rules or terms or in worst case go out of business. Though FGMO is the most reputable firm and established with 10 years in the industry this year, celebrating their 10th birthday. There's also a cap on scaling. Prop firms typically limit how much capital one trader can manage, though it's quite high. Importantly, at the moment, our service is not even open to new clients. We've closed doors because we're fully allocated. There's also a cap on scaling. So for someone watching this, it's not an immediately accessible option, but more of an illustration of an alternative path. Lastly, because the strategy is unconventional, traditional advisors might view it with skepticism. It doesn't fit the mold of stocks, bonds, cash, which can be a psychological hurdle for some investors. For me and our clients at XO, this approach offers peace of mind in chaos. We're not praying for a bull market or panicking about a crash. The returns, while not guaranteed, aim to be steady, for instance, making say 1 or 3% a month, just as a hypothetical range, regardless of market conditions. That may sound modest compared to speculative stock gains, but the consistency and low correlation make it very powerful when compounded, and especially attractive when everything else, stocks, bonds, real estate, is shaky. It's like operating on our own little market-independent income engine. We believe this is especially valuable now, when the macro environment is so uncertain. We are effectively saying Fed hikes, Fed cuts, recession, boom, none of that directly dictates our success. We make money in our own arena. Those are currently closed for our service, so this isn't a sales pitch, just sharing what's possible. If your interest is piqued, note that we're not taking new accounts at the moment, so make sure to subscribe to the channel to know when we reopen doors. But you can also certainly learn more about how we do this at the end of this video, checking the video how we make $10,000 using this hedging strategy with prop firms. All right, we walked through 4 scenarios, each quite different in risk and return profile. Sarah, real estate play, offers tangible assets and income, but comes with concentration risk and potential housing downturns. David's T-bills are ultra safe, but yield limited growth, essentially a capital preservation move. Layla's 60-40 portfolio is a balanced diet of investments, historically sound, but not invincible, especially in rare inflationary storms. And XO's hedge strategy is an innovative approach aiming for uncorrelated gains by leveraging prop firm capital, which can thrive in uncertain markets but requires specialized execution. There is no one-size-fits-all answer for how to invest $100,000 today. It really depends on your goals, risk tolerance, and time horizon. You might even combine elements, like a barbell approach, some in treasuries for safety, some in a hedge strategy for growth, maybe a bit in real assets like real estate or commodities as inflation hedge. The key is to balance the risks. We're in a time where the yield curve is warning us. Gold is flashing caution, and traditional portfolios have been tested. It makes sense to be vigilant and perhaps more creative in asset allocation. For XO Capital's part, we are big believers in the beta-neutral prop capital model as a way to generate returns in any market environment. We eat our own cooking. Our current portfolio is deployed in that strategy, and it's delivered solid returns through the volatility. We only make money if our clients do, so our confidence is backed by our business model. If you're curious to see exactly how we generate these better neutral returns using prop firm funding and hedging, I invite you to check out our in-depth breakdown video that will be linked at the end of this one. In that video, I pull back the curtain on the methods, show real performance, and explain the mechanics in greater detail so you can truly understand the process. In uncertain markets, the traditional paths aren't as reliable as they once were, but by staying informed and open-minded, you can find strategies, old and new, that align with your needs. Whether you choose tangible real estate, the safety of treasuries, a balanced portfolio, or a modern market-neutral approach, make sure it's a strategy you fully understand and are comfortable sticking with. The worst mistake in uncertainty is to panic switch your strategy at the wrong time. Each of these options has its merits. The best choice is the one that fits your situation in these uncertain times. Remember, the goal is not just to make $100,000 grow, but to do it in a way that lets you sleep at night. Thank you for watching and delving deep into these scenarios with me. If you found this analysis useful, please give it a thumbs up and subscribe for more insights. And as mentioned, if you want to dive deeper into XO Capital hedging approach and see how we aim for consistent profits, regardless of market direction, check out the full breakdown video linked on the screen. It's a comprehensive walkthrough that complements what we've discussed here. Stay safe and invest wisely. Good luck and see you in the next one.